If you ever looked at your credit card statement and thought, wait, how is this interest legal? Well, some senators are asking the same question. Welcome back to Beyond the Bill Number, the podcast where we take the headlines about legislation and dig into what the bills actually say and what they might do if they ever make it through Congress.
Because, as we always say, the bill number is just the starting point.
And today we're diving into something that almost every American has experience with: credit cards.
Yes, the tiny plastic rectangle that can either earn you airline miles or quietly charge you 28% interest while you're sleeping.
And that number isn't hypothetical. Average credit card interest rates are now hovering around that number, which is part of why Congress is suddenly asking a very direct question. Should there be a legal cap on credit card interest rates?
And that question is the center of U.S. Senate Bill 381, a bill that would impose a nationwide 10% limit on credit card APRs.
Yes, 10%, which compared to today's market rates is not just trimming around the edges. That's taking a chainsaw to it.
It is indeed a legislative chainsaw, of course. But interestingly, this comes from a bipartisan duo that you might not expect. And something that is even more crazy to me is I have been rewatching The West Wing, and I was watching season 1, and they were trying to pass a credit card rate limit in The West Wing in the year 2000.
Absolutely.
And here
Exactly.
we
It's
are
crazy.
in 2026 talking about
That is the thing about watching The West Wing. I watched it not that long ago, maybe a year or two ago. And yeah, all the storylines are just like, oh my God, they're still trying to do exactly the same things now. Nothing's changed. It's very depressing. Very depressing.
Yeah.
The same arguments, the same issues.
It's pretty crazy to think about the amount of interest that these credit cards can charge. I grew up in a family where I had my allowance docked like $11.13 because I would get penalties of $1.56 for not having my room clean and things like that. And my mom would give me, $13.12 to make, with an itemized deduction.
I mean, when I was growing up, there weren't credit cards. It was literally like nobody had them. Didn't they were just a rich person thing back in the 70s for us? But certainly my parents never had credit cards, and we never had credit. Our house was just filled with ancient stuff. Like we never got a new sofa. We never got a new TV. We had like this massive old-fashioned old TV, way past the age when most people got more modern ones. And it's just because they didn't believe in credit. And so they'd save up, and when they were buying a holiday, they'd save up all the money and then just buy the holiday. A new car, save up the money and get a new car. I think a car loan was like the one exception, but even then I'm not sure they even had car loans. I never grew up with the idea that if you didn't have money for something, you could still buy it.
What's even more crazy is just the immense amount of debt Americans are in, whether it's with student loans, car loans, medical debt, anything like that. And I was watching a video the other day of some guy going around Disney asking people how much debt they had. And one lady was like, yeah, just $180,000. And I was like...
Yeah. People are so relaxed about it these days. Yeah.
I mean, because how are you ever going to get out of that?
So in Britain we call it, I don't know what this is. It's an American expression as well. We say put it on the never never. Do you say it in American? No, that's our, because we wouldn't say layaway. That's not a British phrase. We'd always say the never never. So you buy something on the never never. Yeah, back in the 70s and 80s, I don't think people say that anymore. But certainly, and it was frowned upon. It's like, oh, God, no, you can't do that. No, if you can't afford it, don't buy it. It's terrible.
Yeah.
But credit cards, obviously in the UK now, credit cards, obviously everywhere, everyone's got one. Usually several. I did a little bit of digging into this, whether we have a similar push, and apparently our FCA, the Financial Conduct Authority, did look at putting a cap on credit cards because it was getting so bad, and they decided not to. And I think for much the same reason as we will get into as to why it's very unlikely to happen in the US as well, and why it hasn't happened in the past. Basically because the effect on the market would be so big. They obviously surrounded that with a lot of words saying, oh no, we're choosing other routes to tackle persistent debt, and we're doing all of these other types of things. You might think that a cap in the UK would be even more important than one in the US, given that our average interest rates are at the moment 35 to 36% on credit cards. So even higher than in the US. And that's because our sort of interest rates generally are higher. Bank of England interest rates are higher. It's the same as in the US. People are really struggling how to deal with it. And it's one of those things that people tend not to talk about, but that everybody has it to a certain extent. And some people are really in trouble with it.
And it's this interesting thing also when you just think about the role that this has played overall. Most people use credit cards now just because that's the way that society works. It's a lot of digital money. But because of the transaction fees with credit cards, it's essentially created a 3% inflation on every single thing that we buy because the local businesses have to pay the credit card companies for the processing. And there's all of this other stuff there where if you look into it, it's like, I don't know if credit is necessarily the best thing that's happened to our society.
So my generation, we grew up without easy credit, which means that perhaps maybe we're a little bit more nervous about it. I'm certainly really nervous about being in debt at all. I love not having any debt at all. Paying off the mortgage is obviously the dream, right? But that's something that I think younger generations just wouldn't even contemplate, particularly if you have student loans. Obviously, I didn't get a student loan, so I was like, my government paid for me to go to university. So the younger generations, that you just grow up knowing that debt is a thing and it's just something you have to carry with you, and you just have to try and manage it and not think too much about all of this wasted money that you're giving to the credit card company or various other loan organizations every month because you've bought something you can't afford. But modern society depends on credit, and it depends on easy access to credit, and that's why the kind of bills that we're talking about really struggle, because no political party and particularly no pressure group wants to say, okay, let's switch off the tap to easy credit, because if you did, what would happen? A massive recession. If Americans in particular, and it's the American consumer that drives the world consumer market in consumer goods, if you switch off the tap to easy credit and Americans stop buying, then the entire world goes down.
Well, let's get into the bills then, because it's a pretty interesting thing we're going to be talking about today.
Yes, it is. So we mentioned then that you have a very odd couple who are actually supporting the bill that we're talking about today. And that odd couple is Senator Bernie Sanders and Senator Josh Hawley. Two people at the absolute opposite extremes of the political spectrum, a progressive populist and a conservative populist. And they have teamed up over credit card debt.
Yes, you heard it here first. We have found another thing that people might agree upon. And, 2026, it's a fresh start. But
absolutely,
this is the reason that Senate Bill 381 has gotten so much attention.
Yes, it is. And if anyone listening who wants to actually follow the bill or any of the related legislation that we'll talk about today, of course, you can track the entire life cycle of the bill, including who sponsors it and who votes for it, on Bill Track 50. And you can see there, obviously, all the votes, the amendments, and related bills across Congress and the states.
As we're about to see, this debate isn't just happening around this one bill. It's a really nationwide idea that's getting taken up.
Absolutely. So let's start with the core question. What does Senate Bill 381 actually do?
So at its heart, this bill amends the Truth in Lending Act, which is the main federal law that governs how credit terms are disclosed and regulated. The amendment would set up a hard national cap of 10% APR on credit cards, including financial charges.
Yes. So when lawmakers say APR, obviously a common term that you see on credit card bills and things, that's talking about the annualized percentage rate, so the total yearly cost of borrowing.
Yes, exactly. And this bill also anticipates something that regulators see all the time, which is lenders trying to reclassify charges to avoid a cap. So the legislation includes several guardrails.
Okay. So walk us through these then.
All right. So under Senate Bill 381, credit card issuers cannot charge an APR over 10%. Fees that aren't technically finance charges can't be used to get around the cap, and the total amount of those fees can't exceed the finance charges themselves.
So if a lender tried to say, okay, fine, the interest rate is 10%, but then there's 40% in administrative fees, that wouldn't be allowed. I'm starting to get flashbacks to airline pricing policies here as well. Oh my God, this flight only costs $100. Oh, but our admin charge is like $2,000.
Yes, and you can't forget those convenience fees that get levied on us by Ticketmaster.
Exactly.
So, yes, but exactly. This bill has the strategy to block that. And it goes even further. If a lender knowingly violates the caps, they actually have to forfeit the entire interest on the debt.
That's quite a serious enforcement tool.
It really is. And it's a good way to make sure that people are actually following the rules, because some money off the top is better than no money off the top. But consumers could also sue to recover any excess interest or fees as long as they bring the claim within 2 years of the last unlawful charge.
Okay, and one other interesting feature is that the cap isn't permanent, right?
Correct. The bill includes a sunset clause that ends the cap on January 1st, 2031. So when you look at this, Congress is essentially proposing a 10-year policy experiment rather than a permanent restructuring of consumer credit.
Okay, so maybe you could look then at the credit card saving up all of that interest and hitting you with it in 2031. You get like 10,000% interest on your credit card or something. So procedurally then, how's the bill doing? I mean, where is it right now?
So the bill was introduced in the Senate and referred to the Senate Committee on Banking, Housing, and Urban Affairs, and that's the key committee for financial regulation.
And for people following legislation, this is where tools like Bill Track 50 really matter, because if the bill gets a committee hearing, it gets marked up, or there are amendments, that's usually the first sign that momentum is building. And obviously we will send you alerts on all of that if you're tracking bills.
Yes, exactly. And a lot of these major bills stall at this stage. So committee activity is really the signal that everybody's watching for, seeing if it's moving through different committees, getting passed on. This one committee is a really important one, but sometimes they'll get referred to other ones because other issues will come up. So
why is Congress talking about interest rate caps now?
Well, there's really three big reasons: record interest rates, rising credit card debt, and Trump will not stop talking about it. So the recent reporting showed that the average credit card APRs are approaching 28%, which is a historic high here.
Yes, and meanwhile, of course, the banks themselves can borrow money from the Federal Reserve at much lower rates, which doesn't really seem fair, does it?
It really doesn't. Supporters argue that this gap shows pricing power, not just lending risk, and politically, credit card debt is becoming a major voter issue.
Yes, because unlike a mortgage or student loans, credit card debt is something that millions of people carry month to month and is perhaps not seen as essential as some of those other things. You got to go to college, you got to buy a house, but you don't really have to buy that new sofa, do you?
Exactly. And it is carrying a much higher interest rate than a lot of these other mortgage or student loans carry. And polling consistently shows that voters across the political spectrum are uncomfortable with how extremely high interest rates are. This is actually one of Trump's top polling positions at limiting the rate at 10%. And it's something that he talks about a lot because there's not a lot that he's doing that's being perceived incredibly positive these days. And especially when it comes to money. And it's a really interesting thing to see him kind of juxtapose trying to limit this rate of which we are being charged money while the American taxpayer is taking on a lot of the tariffs that are getting enforced as well. So, you know, the math isn't mathin' for me right there, but...
Yes, absolutely. Okay, so as you mentioned then, this is super popular. It polls very well, so there's a lot of people who support it. There's also quite vehement opposition to this, which is why, even though this has been spoken about for some time, it's never happened yet. In fact, it's probably unlikely to happen this time around as well. So let's first of all then talk about the case for the bill.
Yes, so this is brought to us by Issue Voter Bill, and this is our Issue Voter Bill of the month. But supporters argue that the credit card rates approaching 30% trap borrowers in cycles of debt. So their key claims include that interest rates exceed banks' actual borrowing costs, high APRs make it extremely difficult for borrowers to escape this revolving debt door, and a simple nationwide cap is easier to enforce than these kind of complex disclosure rules if you're trying to have nuance here. You know, the banks have a basic rate. Why can't all the people just have a basic rate that isn't incredibly predatory, just a little bit predatory? Because, you know, it's the cost of doing business.
Yeah. Yeah, absolutely. Credit card companies are businesses too. I don't think anybody thinks that they shouldn't be making money. Perhaps they just shouldn't be making quite the amount of money that they do make.
Right.
But there's also a moral framing here then, isn't there?
Yes. So Senator Sanders has described triple-digit effective payments on revolving debt as economically unjustifiable, while Senator Hawley frames it as protecting working families from predatory corporate practices. Again, businesses exist to make money, but there should probably be a limit to how much you're reaping and sowing from a poor little American out there just trying to buy a fridge. So
It absolutely is. And it is very interesting, again, to just look at how the two ends of left and right are sort of coming together on this issue. And you've got Senator Hawley talking about protecting working families, as well as Senator Sanders, who you wouldn't normally expect to agree on anything. So given then that you've got this sort of wide and unusual support from both the very left and the very right of American politics, why is the opposition so intense, and what are the arguments?
Well, it is very intense, especially from banks and credit unions, if you could imagine.
Really?
Ginormous surprise there. So their argument isn't that rates are too high or too low or wherever they are. They're kind of fine with where rates are. And they think that using such a blunt instrument like this rigid cap would reduce access to credit entirely because they need to charge this high amount to feel good about lending to people who are high risk. And one of the bigger things here is they say that if you make it less desirable for us to essentially just be giving away money to people that can't afford it, which again, maybe they're saying the quiet part out loud there, and that's something we shouldn't be doing. But people are still going to need that money. People are still going to be in these spaces where they can't afford things because we are in an affordability crisis. And they might be going to less savory areas to get this financing than, let's say, Capital One. And that is also a concern because that is, dangerous.
Yes, it is really. So they're effectively saying is that the lenders, all these myriad different types of lenders, credit cards and finance agreements and things, that they price risk into the interest rates. And that's why interest rates are going up right now. There are concerns about the economy. If the economy was to go into recession, then all of a sudden you'd have a bunch of people who maybe are losing their jobs or are really suffering and therefore can't pay off their credit cards. And that's a problem for the credit card company. So to sort of counteract that risk, they charge higher interest rates because that's how it works.
Right. And just simply stopping issuing credit to those borrowers at all might be the effect of having these lower rates because it's just not worth the gamble. But when we look at what this could actually mean in a huge recession or something like that, it's again, I think, why there's these two sides of the political spectrum agreeing. One of the big things there is that they don't want people to be going to payday loans, title loans, unregulated online lenders, loan sharks. There's a lot of industry groups that have younger borrowers, that have credit histories that are shorter, and that could be disproportionately affected. So there's this weird role in society that credit plays now. They're saying this is a house of cards, and if we cap the interest rates, it all might come crashing down.
Absolutely. And it is worth looking in the past for this. But as we said, back before the 80s, you didn't have easy access to credit. And so people just didn't get credit cards. So what did they do? People still borrowed money. But it was loan sharks, right? And the loan sharking industry was huge back then. And they was effectively gangsters. So it was like organized crime organizations who would lend money to people and then break their legs if they couldn't pay. Absolutely usurious rates of interest. And so what the credit card companies are saying is basically, anybody who's a risk, we won't give them a credit card, we won't lend them anything, and they're therefore going to have to go to these, and you would see a flourishing of that kind of criminal type of lending. It is an interesting bill. The arguments against it basically boil down to, if you were to do this, it would have a massive impact on consumer spending habits and lending habits and things. So it would be a huge shock to the system. Do we really want to take the risk? Maybe it'd be great. I think maybe it would work out fantastically and everyone would have cheap credit. But on the other hand, maybe it would be a catastrophe and could usher in all sorts of bad effects on the economy. But one thing that is interesting about this bill, and I think is why it's attracted the populists effectively, because it's a very simple, very populist sort of solution to a problem. And it does take a very different approach from other credit card reform proposals.
Yeah, I think that's a key point there. For example, the Credit Card Competition Act, which was reintroduced by Congress in January this year, tries to lower costs by increasing competition between payment networks like Visa and MasterCard. So this is when I talked about a little bit ago. We had a blog post on it, but it's something that is trying to use this idea that we still kind of believe that we have competition in our capitalistic society, when really there's just a lot of monopolies going on, and Visa and MasterCard are a monopoly. And so they can really control the extra charge on your credit card transactions. And so they're making a lot of money on that. If there was more competition, that would theoretically help drive it lower. But it does seem like even in these places where there is competition, everybody's kind of agreed, no, we want to make money. So we're not going to drive the price down. If we all just kind of agree to charge, then...
That's right. The Credit Card Competition Act, another one of those perennial bills that keeps coming around every time, every January. There it is. Boom. Another bill, though, that Trump is supporting very strongly. He sees these two bills as very much complementary. He would like to see both of these go through, ever the populist. Because, of course, he's not really into the nuance and the detail. He doesn't see that if you were to pass both of these two bills, again, massive shock to the system. Could be good, could be bad. But who wants to take the risk? And credit card companies, they're all about managing the risk. Okay, so the Credit Card Competition Act then focuses on the payment infrastructure side of the market rather than the actual rates themselves.
Yeah, exactly. So S381 legislation skips the market mechanics entirely and simply just says, here's the maximum price that you can charge. So philosophically, these bills really represent these two different strategies for reform.
And of course, these two bills aren't happening in a vacuum. There's a lot of other related bills floating around.
There really are. If you search on Bill Track 50, you'll see lawmakers are experimenting with several different approaches here. So for example, we have U.S. Senate Bill 2781, which proposes a 36% nationwide cap on consumer lending. So that would include things like payday loans, title loans, credit cards, these other types of things. Then we have New York A7020, which would impose a 10% credit card interest cap in New York. Then we have Missouri House Bill 3021, which proposes a 36% cap on certain consumer loans in Missouri.
Wow, thanks for that, Missouri. A 36% cap. We're not allowed to go above 36%. I'm sure Missourians are really excited about that one. But they don't all reform target interest rates.
Right. Some focus on fees instead of APR. So, for example, we have U.S. Senate Bill 3660, which would cap credit card late fees at $8. Then we have North Carolina, House Bill 508, which lowers the maximum monthly interest rate on these revolving credit accounts.
Okay, so lawmakers broadly agree then that there's a problem with credit costs.
Yeah, they just disagree on how aggressively the solution should be.
So realistically then, what happens next with Senate Bill 381?
So financial regulation bills are notoriously difficult to pass. The banking industry has enormous lobbying power, enormous money to pay those lobbyists because of these high fees. And interest rate caps are among the most controversial tools in Congress on the use of this.
So it sounds very much like the two plucky senators are sort of fighting against the tide of money and influence here. And the next milestone to watch is the committee action.
Yeah, exactly. Hearing or markup in the Senate Banking Committee would be the first sign that the bill has real traction. They're actually paying attention to it. They're actually listening to it. I could see that happening because, again, of this attention that Trump is bringing to it. But even if this specific bill doesn't advance, there's definitely a broader trend here.
Yes. So we speak a lot about the Overton window, don't we? Particularly with, say, a more sort of right-wing immigration-related policies. Perhaps this is one where the Overton window is like shifting this conversation to the unthinkable. Maybe it can actually become thinkable, and in the future, something will actually be done on it. Particularly if Congress is becoming more willing to ask these pretty fundamental questions.
Yeah. How expensive should everyday credit really be allowed to get?
Yeah. So if you want to follow Senate Bill 381 or any of the credit card reform bills we mentioned today, you can track them in real time on Bill Track 50.
Like we said, you can see every amendment, vote, committee step, because the story of this legislation usually unfolds long before the final vote.
Yes, so thanks for listening to Beyond the Bill Number.
And remember, the headline might grab your attention, but it's beyond that bill number where the rubber hits the road.